This is a short video about Chapter 4, Consolidated Financial Statements and Outside Ownership. This is what occurs when the parent company does not own 100% of the subsidiary. Once again, we have a worksheet on page 151. King Company has acquired 80% of Pawn Company. The first entry put into the worksheet is the S entry, where the subsidiary's equity is eliminated. To do that, we are going to debit common stock for $230,000 and retained earnings for $580,000. We are then going to credit the non-controlling interest in Pawn line for $162,000, which is 20% of the total amount of the common stock and retained earnings for Pawn. To finish that entry, we will credit the remaining 80% to the investment in Pawn account. The next entry is the A entry. This is where we allocate out the excess of fair values over book values. We will start by debiting trademarks for $60,000, debit patented technology for $114,000, which is the $120,000 difference less 1 year's amortization of $6,000, debit liabilities for $35,000, which is the $40,000 difference less 1 year's amortization of $5,000, and debit goodwill for $25,000, which is the total amount of goodwill calculated in figure 4.3 on page 147. To finish this entry, we must credit equipment for $9,000, which is the $10,000 difference less 1 year's amortization of $1,000, credit investment in Pawn Company for 80% of the remaining total, which is $180,000, and credit non-controlling interest in subsidiary for $45,000, which is 20% of the remaining total. The next entry we will complete in the worksheet is the I entry, which eliminates intra-entity income. We will debit $64,000 in the equity in Pawn's earnings account, which zeroes that account out, and credit $64,000 in the investment in Pawn Company account. The next entry is the D entry, which eliminates intra-entity dividend payments. We debit the investment in Pawn Company account for $40,000, which is 80% of Pawn's dividends, and credit the dividends paid account for $40,000. The final entry we make is the E entry, which is for this year's amortizations of the fair value allocations. We are going to debit amortization expense for $6,000, debit depreciation expense for $5,000, and debit equipment for $1,000. We then complete this entry by crediting depreciation expense for $1,000. Remember, the equipment was overvalued, credit patented technology for $6,000 and credit long-term liabilities for $5,000. There are two amounts credited to non-controlling interest in Pawn. January 1st, the S entry for $162,000 and the A entry for $45,000. These two entries are added together and a total put in the non-controlling interest column. The remaining $10,000, 20% of Pawn's dividends, gets moved into that same column as well. The final thing that needs to be allocated to the non-controlling interest column is the non-controlling interest portion of Pawn's income. Pawn had net income of $90,000. The annual amount of amortization we make under this consolidation is $10,000, on page 147, figure 4.3. After we back out that amortization, that leaves $80,000 of net income. 20% of that net income is $16,000, and that is allocated to the non-controlling interest column on the worksheet. This sums up the worksheet in Chapter 4. I hope you found this video helpful.